Welcome to the Dividend Talk podcast, episode 243, Dividend Traps with special guest Nathan from the Dividend Watch. Hey, European DJ. How are you, buddy?
I'm good. Easter is starting. It's Good Friday today. So, after this podcast, it will be all on preparing the house, the garden, everything for when the guests come so that we have a nice Easter here. I did learn that it will be storming tonight, so let's see how that goes. But it's that time of the year already. It goes really fast. It's already mid-April.
Yeah, and that means spring cleaning for you, right?
Yes.
And I'm talking about your portfolio, not your cleaning of the house.
Yes, I've got a few stocks that I need to look into and clean up.
Nice.
How about yourself?
Yeah, same for me. Long weekend. I like Easter weekend. We have Monday off work, so lots of time to spend. We do this Easter hunt here with the kids. So one of our family members lives out in the countryside. I don't think you've been when you're here, but there's nice trees and forests, and we hide all Easter eggs, and loads of kids go, and it's great fun. Hopefully it doesn't rain. That's the main thing. But today we have a guest on the show. We have Nathan here from the Dividend Watch. Welcome to the show, Nathan.
Thanks, guys. Good to be here.
Just for our audience, maybe if you can just introduce yourself just a small bit, maybe a little bit about your background and who you are.
Yeah, of course. So my background kind of came up as a buy-side analyst looking at fundamentals and covering various sectors and industries over time. I have a particular interest in technology stocks and love finding technology dividend stocks and also growth ones as well. And also one of my favorite industries beyond technology is just restaurants and fast food because I like their business models as well and covered them pretty extensively over time. But yeah, came out through the buy side as a stock picker and then kind of moved into the online space over time and worked at Motley Fool, which I'm sure many investors may be familiar with as their online presence. And now entrepreneurially work for myself running Dividend Watch.
Nice. And Dividend Watch is a portfolio, correct? Portfolio tracking.
Yeah, it's a portfolio tracking product. We're building it into kind of a broader all-in-one solution for dividend investors. But right now, it is a portfolio tracker product. So if you want to see about your performance, or at least for people in retirement, track your income and see what you're going to be earning by month, into the future, it's a reliable product for that.
Nice. All that fun stuff we love. Does it hold European dividend stocks as well? Because we've a mainly European audience. Yeah.
Yep.
Nice. Perfect. Well, look, we'll link to that in the description of this podcast, but we'll get into talking to you later a little bit more. We're going to talk about dividend traps, I believe, but we may touch on other subjects too. But before that, let's talk about some news of the week. And what about Johnson & Johnson, guys? We are dividend growth investors, and these guys just keep raising dividends consistently. Another, was a 5% dividend hike or something?
Yeah, 4.8%, 63rd consecutive yearly increase. It's kind of crazy if you think about it. Put it in perspective how many companies are out there that have done that. It really is impressive.
It's beyond beyond 2 generations. Imagine that. You must have been, if you started when you were 20 years old and bought Johnson & Johnson, you would have been 83 now. Imagine that. And it always sounds nice, right? 63 years, but it's the same with Coca-Cola, what people say. But imagine that you bought that stock, Johnson & Johnson, at the time that it initiated the dividend. Yeah, how many people do that? That is kind of like Meta, Google, and such initiating a dividend lately, right? Probably a very small yield and everything. Okay, maybe in those times the yields were a bit better, but that's kind of the dynamics that you're looking at, right?
Potentially you have a company now, if you own, and you mentioned tech companies, Nathan, but the ones that have started to pay dividends, potentially in 50 years' time, they could be dividend kings. You just don't know. But it takes a lot for a company, particularly in the pharma and healthcare industry, to consistently pay dividends for 63 years. I was a bit worried about them, honestly, when they sold their consumer health business. It made them more kind of like a biotech, but they haven't let off the gas. Their earnings just are consistent and their dividends follow. So quite impressive, I'd say.
Yeah, and if you look at it too, people, if you're looking for kind of an entry point, right now it's kind of bouncing around those 52-week lows as a lot of stocks are without all the uncertainty in the market. But it seems like a fairly timely, initiation point. And of course, I'm sure Johnson & Johnson, when they sent out their press release, they were happy to announce that 63rd release and like, hey, we're at 52-week lows. Come on board.
Yeah, certainly. There's a lot to be said for these tariffs that Trump has released, because it's created some great opportunities in the market. I mean, everywhere you look, there's a company bouncing around a 52-week low, and it's hard for us retail investors because we've only got so much money. So there's only so many companies you can buy. But as a starter investor, you can't go wrong looking at Johnson & Johnson, I would say.
What are maybe we're going a little off topic here, but what is your guys' perspective kind of in the European area on all the tariff uncertainty, long-term perspective, because that's kind of what I invest for and, and so forth, look for perspectives, but what are about your thoughts on it?
Yeah, it's a tough one. Long-term perspective, Trump is only in office for 4 years. So we'll see what happens after that. But we've touched on this a small bit on the podcast and even offline, and I think there's a greater plan there. I think it's all smoke and mirrors at the moment. Obviously, I'm from Ireland, which has a big pharma presence, and if the pharma companies leave, it will cause a lot of hardship here. So there's definitely elements to it that are scary from where I live. But I think long term it'll sort itself out. Countries will do deals. I think it's mainly going to be a tariff war between China and the US, which is something that's not new, I would say. But I think how he's gone about it is just kind of the shock effect is pretty damning, I'd say.
I think that the tariffs are mostly a lot of noise on the short term, but it's triggering an underlying issue, and that's, I think, just the depth, the feeling that it's unfair. Whether that feeling is right or not, that's something to argue about. I really don't understand why Americans are so nervous about competition. They have all the big tech companies, everything is in there, the innovation, and what they are now doing is they're just alienating their allies effectively in the world stage. And I really think like the last continent that Americans should be afraid of is Europe when it comes to competition. So, and when it comes to tariffs, it's just in the end a bit of populism, I think. And you get the president you deserve. Let's say it like that. So if the country is so divided and struggling with each other, and what it is with politics, right? There's no politician that will say, you know what, for the next 4 years we're going to tie up the belts. Everyone will have to give in a little bit. We're going to raise taxes so that we can get our balance sheet in order again. And I don't see that happening. So from that point of view, I think America is acting like they're a country that is being cheated on, the feeling. But if you look at Europe and we look at big tech companies, and you talk, for instance, about the Apples, the Amazons that are not paying really tax in Europe, but making use of all the infrastructure and all the facilities here that we pay tax for to contribute that happening, then I think there's an unfairness from two sides. But somehow both those unfairnesses have kept each other always in balance. That's how I look at it. So I think it's a lot of noise on the short term, Nathan. I think long term, I'm more on Ray Dalio's side. There's a wealth gap. This wealth gap is increasing. And also, if you read the books of Thomas Piketty from 21st Capital in the 21st Century, he was predicting all of this already, how empires come to an end. And that's more the longer term philosophy that I see, because it's a bit more historical and a bit more data driven.
Yeah, those are interesting points. And I'm an eternal optimist. So I agree. There's some sort of end to the means currently. But here is how kind of I look at it from being an optimist is if tariffs continue and prices increase, we're going to see truly if these companies have pricing power.
Yes.
This is the biggest test that we're going to see.
Exactly.
And the people that shine, I'm sure management on their earnings calls are going to be a little more cautious and say, do we really have pricing power?
Exactly.
It's going to be proof of whether that is the case. So I think there's opportunity, not only with stocks, decreasing in value with the uncertainty, but
And you bring up a good point, because there's a bit of an irony in this, right? America led the global wave of globalization, but also offshoring for the last 2 decades. But that was mostly benefiting the cost side of the business. Yeah, but with what happened because of that, there's more interdependency on other countries, but then politics comes in, where politicians effectively in those countries can hold you hostage, right, with their policies. And I think, therefore, over time, America, but you have the same in Europe, right? With the countries and the companies that have lost independence with that, and I see tariffs also a bit in this area to bring back more independence back. But that's hard if you push for entire global system, supply chains, and everything. So to your point, the only way out is pricing power, Nathan, here, because it was all done the last 2 decades on the cost part.
Yep, absolutely.
Yeah.
Yeah.
But I think it's actually a good bridge into the Dividend Aristocrats stock performance, because the market doesn't seem to be a safe place at the moment. It's kind of choppy, it's rocky, it's up, it's down every second day. But you had some interesting statistics, I think, Nathan, about the performance of the Dividend Aristocrats versus, say, the S&P 500.
Yeah, and we're looking year to date, and of course, with a long-term
course.
perspective, year to date is year to date.
Yes,
so
yes.
take this with a grain of salt. But if you look at the performance of the ProShares S&P 500 Aristocrats ETF, it's a symbol NOBL, Noble. Year to date, plus 1.78%. Not going to make you rich, of course, but if you look at the S&P 500 with a basket of stocks, dividend and non-paying dividend stocks, negative 4.9%. And also, interestingly, I don't know if you guys have seen this graphic floating around online, but if you follow socials or like dividend investing, you probably have come across it. But it shows the year-to-date wealth changes of the top billionaires, richest people. Warren Buffett's the only guy who's positive. And we'll caveat this with Warren Buffett. Berkshire doesn't pay out dividends. He takes his dividends and reinvests
exactly.
it. But he is a high-quality dividend investor with a long-term focus. So it's really interesting when you look at those data points, of course, year to date.
Exactly. And Warren has been stacking up the cash for the last 12 to 18 months as well. It's almost like he knew something was going to come in the stock market, wasn't it?
Yeah. And here's something too, thinking about Buffett, because pretty much at this point, Buffett at his age, his lieutenants are doing the stock picking. So a lot of people talk about Buffett and say, man, he is the smartest investor out there. I'm like, he surrounds himself with good people.
Yeah, for me, it always sounds like this story, this children's story, the turtle and the rabbit. Yeah, where the turtle in the end wins. And that's what I see here as well.
Yeah, but it's not sexy to invest like that. I mean, psychologically speaking, when you see high yields or any sort of high growth companies, it's going to draw anyone's attention. Like we're humans, our brains are wired to seek out that risk. So it's, Peter Lynch, I think he said, what's the quote? To be a great investor, it's not about, or the most important organ is your stomach, not the brain.
Yeah.
It's really important.
But there is something going on, right? I have a feeling that we are seeing, starting to see a reverse to the mean. If you look at LVMH, if you look at Novo Nordisk, those stocks were typically double price from where they were today, ASML. Yeah. And it can't be that in a matter of few months, when they are 40, 50% down, that suddenly the whole investment fees is changed for those companies. I can't believe it. Those companies, they don't just change like that. So I have a feeling that they were priced for perfection. Now with the tariffs, people have been selling, and these stocks are also in indexes, so they get thrown out with the bathwater, right? But at the same time, I also feel like it's are we seeing for the first time almost in a decade a reverse to the mean? Maybe it's more like I'm hoping for it, but for the first time, those stocks start to come into reach again, which is also very interesting.
Yeah. And here's an interesting point. Here's the insanity of the stock market compared to every other rational behavior out there. So let me throw out a scenario to you. If you guys are looking to buy a new iPhone for one of your kids and it's $1,200 today, and 2 weeks from now it goes down to $800, what are you going to do?
Yeah, buy it.
Exactly. In the stock market, if there's a stock essentially is down 2 weeks, a month from now, at a better price point, investors are going to say, I'm going to sell, I'm getting out. But the long term, like if we look at it from the perspective of the long-term fundamentals of the business, what has changed? But that's the insanity of the stock market and how emotions play into investing. When things go on a discount, we don't naturally say, oh, I'm ready to buy, let's go and get it. It's, I'm scared, I'm fearful.
But the good thing is dividend investors are built differently.
They are.
And we have a Facebook community with a few thousand people there. And when the stock prices went down, everyone was like as a kid in the candy store. People were like, buy, buy, buy. Maybe a bit too early sometimes buying the dip, but that's what I love about dividend investing. If you look for contrarian investing, dividend investing has this kind of by nature, because you know that you get more passive income for the same amount of cash deployed if you dollar cost average on a monthly basis. And that's really nice.
And that's why we have to build this community of dividend investors, because if you really think about it in the grand scheme of all investors, that niche is tiny. So you've got that niche of smart investors, but the majority making the incorrect decisions. And it's really hard to get people involved in those communities because, you know, dividend investing, it's slow growth. It doesn't grab the headlines. It's not going to grab people's interest. But honestly, long-term fundamental investing, it's where it's at. That's where the wealth is built.
But you don't see CNBC highlighting like dividend has gone up 10%. No, it's always share price. It's always this share price is up, this share price is down. So it's tough. I get it. We consume so much information from other resources that if that's thrown in your face all the time, that's all you're going to think about. So that's why I try and stay away from those, stay away from the noise, and just try and focus on the fundamentals. It's boring. It's not sexy, but it works. So that's what we do. You mentioned LVMH EDGI. Did you have a look at their earnings last week or this week?
Yeah, I just want to say, like, just really quickly, right? It is Asia, excluding Japan, that went 11% down. We all know that's China.
Yeah, of course.
So China is hit hard there. I don't know if it's naturally also anti-European, anti-Western sentiment that's playing a role there. America with the tariffs is being used a little bit as the uncertainty there. But also United States dropped 3% in sales. I think just LVMH, what people now start to see is why it is classified as a cyclical, consumer stock. Yeah, because I think it's easy to forget that if you started investing 7-8 years ago, you wouldn't have learned what consumer cyclical means. A little bit during COVID, maybe. Maybe for some, but COVID was so special that it was not a normal recession or something like that. It was more hit to whether you an online business or not, depending on foot traffic. If you were depending on foot traffic, you had generally issues, whether you were cyclical or not. But now for the first time, you start to see a little bit like why some businesses are classified in a cyclical sector. And for me, LVMH is such an example.
But the China story is not new there. We've been speaking about that for the last 12 months, but it's just coupled with the tariffs and what's going on. But China has been weak for quite a while for those guys.
But then you have Hermes, and Hermes was again like double-digit growth almost everywhere. I mean,
but they're different.
It's crazy. It's So you have luxury. But then there is something luxury that is really luxury, right?
you spoke about pricing power, Nathan, and I'm not sure if you're aware of Hermes, but they are the cream of the crop luxury over here in Europe, and they sell bags that you just can't walk into a shop and buy. So that's why they're double-digit growth year on year over year. It's only the rich investing there. Okay, nice one. So we might get into the main topic, and the team is going to be around dividend traps, but it might not necessarily always be about that. And you kind of touched on a point earlier, Nathan, about how we're wired and how we look at things. But given your background, why do you think that high-yielding dividend stocks attract investors, especially during these type of markets?
Yeah, it's a good question. And I'll actually kind of go back. Part of my background too is I was a psychology major in college. So I always liked understanding kind of the fundamentals of how everyone thinks and what drives them. And obviously it makes sense in the stock markets. But if you look at kind of psychologically speaking, greed, it's a scarcity mindset. So It's a fear of never having enough. So if you're investing for retirement, it's like, hey, am I on track? That's a scarcity mindset, a fear of not having enough. If you're in retirement, relying on income, do I have enough income every month or every year to support my expenses and kind of my lifestyle? So anything that helps us get to that endpoint faster, or maybe answers that question, do I have enough, is going to naturally attract our brains and get us excited. So you see high yield, you see high growth. Those are two of the traps out there. They can be traps, I'll say that. Those are the two of the traps out there. And that's fundamentally why people are attracted to high yield investments or high growth investments, because they're sexy. It gets rid of that scarcity mindset.
And trying to reach that end goal a little bit faster. It's just patience, really, at the end of the day. But is there a difference then in high yield and sustainable yield? Can you have a high yielding company that's sustainable, for example?
Yeah, absolutely. I mean, if you look at it, I'll use this analogy. Taking a big salary at a startup versus job security at the stable business. So maybe you take a big salary at the startup, but it goes bankrupt 2 years later. For those 2 years, you're doing well. You know, you're paying your income. You're getting your income, your mortgage covered, daycare, everything. You're comfortable. But most people are going to be attracted to that. But the longer term job with the security and good benefits and good enough pay to help you cover your expenses and invest for retirement, that's really the analogy of high yield versus sustainable yield. And you may see high yield out there, and if you look at ratios and so forth, the traditional EPS payout ratio or yield and anything, you can get a good sense of which are the fakers and kind of which ones have sustainable yield. But it's an important differentiation, because sure, you can have high yield and sustainable. You can also have low yield and unsustainable.
Yeah, that's true. Actually, that's true. And I know you're fascinated by the psychology of all this, being that was your major. Like, and do you see trends in terms of demographic or age groups? Like, the younger people tend to go more toward high yielding, or is it even older generations? Is there a gap between people and how they think and how fast they want to reach that goal?
I think it's a matter of experience, and also whether you're a male or versus female, because men are naturally going to be take on more risk than women will in investing in other scenarios. So there is, kind of how our brains are wired. That's going to affect men more than women. Also, experience comes into play. If you get burned on 1, 2, 3 high yield investments, over time you're going to learn, okay, maybe I should stay away from those. So really, look to the people that have experience in the markets. Maybe the retirees, they've been through a lot. Pick their brains on why they're investing in certain securities. But you're definitely going to see those biases based on gender and also experience, which correlates closely, obviously, to age.
Yeah, interesting. Is there any red flags you look for specifically when you're looking at these types of companies?
I like to go for EPS payout ratio. It's the easiest one to find for most companies and most consistent. Now, of course, with like REITs and BDCs, take it with a grain of salt, because there's going to be a different range that's really important. But typically, I have a blueprint, which we can talk about later, of how I screen for dividend stock ideas. And one of those is simply just looking at 60% or less, or 60% or lower EPS payout ratio. Once you're getting above that, doesn't mean it's a company that can't sustain its dividend. It's just a flag to do more research. But if you see, a high-tech company paying out 100%, maybe be a little uncertain about it and do more digging on it. But that's the easiest one I've found and most reliable, that can just give you a quick insight.
Yeah. Look, you touched on your blueprint. We might as well get straight into that. What you look for when you're screening for companies? What does that exercise look like for you?
So it's a 6-point checklist I kind of developed over time, and I came up with the factors to be as applicable as possible across as many sectors as possible. Now, there's going to be nuances to each, but 6 points that we look at: payout ratio, less than 6%, dividend CAGR, 3 or 5 year period, greater than 5%, also EPS growth, greater than 5%, market cap, want to make sure they're proven, greater than 10 billion US dollars, debt to equity, less than 2 times, and then 10 plus years of increasing dividend payments. And I use that as kind of the broad screen just to find what dividend stocks I want to research further. It's going to turn up some duds, but also to turn up some interesting opportunities that are definitely worth looking at. But if you kind of like, if you look at those factors, everyone talks about, management effectiveness, pricing power, efficient deployment of capital, investing in the right opportunities. Those factors capture whether a company is truly good at that and has an advantage or a moat over time and has been consistently doing so. So it's just kind of an easy approach that gets you an initial insight into what opportunities are going to be best.
Yeah, and it's a good point. It's also hard, right? Because how do you measure management? Yeah, for instance, I will never forget Kinder Morgan. It was 2016 or something like that. We had this oil glut, and he said, my business is like a toll gate. Oil flows, I'll earn anyway until the oil stopped flowing. But he was literally saying, like 1 or 2 weeks before dividend cut, like, no, the dividend safe, everything. And he's a founder, so it was a founder-led business. Yeah, yep. Good track record of dividends, and still you get fooled. But you could have seen it in the numbers. Yeah. But what was also interesting, that it crashed the whole thesis of the tollgate thesis, why people, it was written on Seeking Alpha everywhere. That was one of my learnings, that it burned really quickly, that you shouldn't just also copy the investment thesis from others and really think like, okay, what's the worst that can happen? Can it be that if there's an oil crisis, that the oil just starts flowing? Yeah, stops flowing. Yeah. So to your point, sometimes it's just much better to stick to the data and then start looking at management, whether management kind of rhymes with what the data is telling us.
Yeah, and I mean, if you look at it, the market of stocks is so large, especially if you're going beyond U.S. markets and looking internationally and everything. It's easy just to succumb to paralysis analysis if you're a DIY investor. And where do I start? Everyone says I should look at management effectiveness, but this guy says I should look at ROE.
Exactly.
And this one says I need 50 years of dividend increases. And this analyst consensus estimate is underperformed. There's so much noise and information out there that I understand why it's so hard to be a DIY investor. And like I've developed this blueprint over time. I fine-tuned it down from probably 20 factors what it was historically and just more complex. And it just, kind of going back to what we chatted about demographics and so forth, experience really does give you good insights over time. Yes. And even I started investing, thankfully, my dad got me into investing when I was 15. And I shun to think about the analysis or lack of analysis I was using to pick stocks at that point. It's probably just like, hey, what are my favorite products and what sounds interesting? Okay, let's buy some of the stock, which actually isn't a bad way to get started investing if you're young.
Yeah, and you can't copy experience either that easy, because to your point, like let's say even Buffett, right? A lot of experience, he's always sharing it. But I came to the conclusion that what is probably even more important, if you want to be able to build on that experience of famous investors, your character needs to align also with their investment style. So I'm probably boring. Probably a lot of patience. So dividend investing works for me, but I think if you have a lot of adrenaline all the time and you want pace, quickness, it's sometimes really hard to stick to dividend investment, because you're easier subject to falling into such traps of making quick bucks still. And Derek here is a good one in that, by the way. He liked option trading a lot, and
hey, I've been there too.
Yeah, we all make those mistakes, but it's well documented at this stage.
And mine wasn't selling call options on long-term stocks. It was much riskier stuff.
It happens. But you mentioned you started investing when you were 15. Was that in the stock market?
Yeah, it was. I remember. So my dad, he had one of the talks with me. He's like, hey, let's talk investing. And he was super into it and always had been over time. And I'm thankful for having those experiences, because unfortunately, I started around 15, 16, but I probably took 10 to 15 years off while I got my income and finances set. And those 10 to 15 years, going back that time frame, when you look at compounding, it's such, that could be millions of dollars lost for investors over the long term. So yes, I did get started early, but I took that time off, unfortunately, when I was kind of figuring out income and so forth. But it's really good lessons to learn. My son's 7 now. I've taught him about investing already. So
Yeah. Do you still hold any of those companies?
no, I don't.
No.
Because they were all just bad investments. I remember one of them at the time was just hype, investing in Crocs when it IPO'd, and lost a ton of money on that. And I don't even know where the company is today. I'm sure it's a much stabler state, and it's been growing well since that point. But I tend to look at the chart and think, so when was this? This is probably late 90s, early 2000s. I'm sure if I just held on to the stock, it would have been a great return over time.
Yeah. It's interesting because I have 2 sons, but my oldest son is 14 now, and his portfolio, he has his own portfolio. I let him pick his own companies.
Yeah.
And one company he picked at the time was Roblox. It was big at the time, and European DJ, you'll know this, kids loved it. Now it's gone out of fashion. But I let him pick all his own companies. He comes to me, I want to buy this. I'll ask him why. And if he gives me a reason why, I won't question him. I'll just let him buy it. Let him make his own mistakes. But it's fascinating to watch how he ebbs and flows into it. So he might look at it for like 3 months, and then he might not say anything for a year, and then come back and say, "Dad, can I invest again?" I'm like, "Yes, of course you can. Let's look at it." But I think it builds a good foundation, right?
Yeah, it's interesting too if you look at it. So I know we kind of went through the 6 steps I use to find stocks, but the simplicity of just initially getting interested in companies that you know about, it can be a pretty valid investment strategy. I'll give you 2 examples. So I don't know if the situation in Europe is the same as it is out here when buying a car at a dealership, but it's a miserable experience. People try and take advantage of you. The finance guy is a shark. It takes hours to do. So I remember the first time I bought a used car off of Carvana. Literally took me an hour online to find a car. They delivered it to my door, got me the lowest financing that I could find in the market. Completely seamless experience. And without even doing any research, I'm like, 20 years from now, this is going to be how things are done. I bought the stock. And I've bought, throughout its dips, it's gone from $230 down $230 USD down to $1. I bought at $1. And now it's up around 170, 200s in terms of the price. So like they were in a dangerous situation.
Yeah.
They were over leveraged, very close to bankruptcy. But if you just kind of look at the long term of it, it's interesting. And also there's a company in the US, I don't know if they're international yet, but Wingstop. They sell chicken wings. And their big thing was during the COVID times, they were seeing a huge rush into the stores for their delivery services. And I was kind of looking at it thinking, every time I would go in there during COVID, they had long lines. They were busy. The wait times were really long. So I'm like, let's look into this stock and see what it's all about. And prices over time have significantly increased for them, their input costs, but they have really impressive pricing power, been able to pass that on to consumers. And overall, it's been a really good stock from a growth perspective, tiny yield, but definitely from a growth perspective, yeah.
So it sounds a lot like how McDonald's started. I watched a documentary on that recently, pretty much how it started. So, but it takes a lot of, I would say, confidence or conviction. We always say you can't borrow conviction, but if you hold a company that drops from the mid hundreds down to $1, how did that make you feel? How did you have enough conviction to still invest at $1?
I mean, it's not easy. I can look back and say, was a great stock prediction and I knew it all along, but no, you don't. I'm sure all of us have been through that. I'm sure all of us have been through the other side of it where it has gone down and we haven't bought and back at it and think, okay, what was I thinking? Why was the fear there? Fundamentally, not much has changed about the business. And the Carvana case, very different, and it's not a dividend stock. But like I said, they were close to bankruptcy and in a very dangerous position. But if you kind of look at the long-term perspective, and I also consider how much I'm putting into it versus how much I have invested in the market, what's the total risk?
Yeah.
When it comes down from 230 to $1, it's actually a small investment in the grand scheme of things. So it made up less than 5% of my portfolio. So if things went south and they went bankrupt, 5% over 4 decades, who really is going to notice it in the end?
Yeah, nice. And yeah, I mean, I don't know if I could do that. I've had plenty of situations where companies drop, but I don't know if I could buy them at that amount.
But you have that now as well, guys. Yeah, if you now look at how narrative has changed for some stocks. Yeah, again, let's take the narrative of Novo Nordisk. Yeah, it was like trading almost twice as much like half a year ago. Yeah, and now suddenly, is it really that Eli Lilly is taking everything away? I mean, we mentioned it before. There's like an unlimited supply of kind of fat people in the world. Yeah, so there and those are slightly different compounds. There's a place for both of them, and the market, if it's now at 50 billion or something like that, is expected to grow in a few years to 100 billion. So there's also Ozempic, the brand. I mean, rappers are rapping about Ozempic, as such. So, but then the narrative changes, and suddenly some people think it's trash, right? And I think that's hard because when stocks go down, the price starts to drive the narrative, and suddenly everything is bad about a business. Remember when Ahold Delhaize bought Whole Foods, and we put this example more often on here. Walmart was going bankrupt, Target was going bankrupt, Ahold Delhaize was going bankrupt, all of them. Maybe not bankrupt, but there was no future for them if Amazon would enter the market. Yeah, the same was Amazon entering the freight market with UPS and such. They would be all out of business. Of course, it creates an issue for UPS, but look at where it's trading now. Yeah, so, I'm not a big fan of UPS in general, but what has fundamentally changed from a year ago to now? Why UPS deserves to trade at, what is it, 7% yield now?
Yeah.
I mean, this is really what they say in social media. If you liked it half a year ago, you must love it now. Yeah.
And who would have thought too, today, the price to earnings ratio of Amazon and Walmart would be the same, which they are.
Exactly.
Crazy. Yeah.
Exactly.
Yeah, interesting thought. But then you must have a lot of, I mean, you have a portfolio tracker, so I've seen somebody have over 30,000 users. So you must have some data on what types of holdings investors have. Like, what are their top, say, 5 or 6 holdings that typically dividend investors would hold?
Yeah, we can get into it. And also, I'm interested in your guys' perspective because I provided you the list. And I know when I looked at it the first time, I was like, okay, that kind of doesn't make sense, but I get it. But yeah, looking across our investor portfolios, we're able to kind of see what holdings are in everyone's portfolios. So top 5 securities, I'll run through the list here. Realty Income makes sense as the number 1. That's always been a dividend investor favorite. Whether it's a good investment is questionable for the long term. Everyone has their opinion. Apple.
Yep.
Yeah, that's probably your dividend growth investment, but not a traditional dividend player. SCHD, the Schwab High Dividend ETF, perennial favorite for anyone who's into dividend investing. If you look at Reddit dividends, literally every other post is about SCHD. And then you've got Microsoft and Altria in the 4th and 5th positions. Altria, of course, makes sense. But yeah, and going down the list too, you've got a lot of well-known names. Johnson & Johnson is in there. Amazon's in there, interestingly. Non-dividend pairs, but it kind of tells you, the theme of even dividend investors, for the most part, having more of a conservative bias, still gravitate towards some of the high growth stories out there. And we don't necessarily have the age demographics behind all these portfolios, which would be interesting to see. I'm sure there'd be some interesting trends based on the ages of people. But my guess is people investing in some of those higher growth companies are a little bit younger and hopefully not in retirement.
Yeah, there's some interesting choices there. I see one that surprised me is in the top 6 or 7 was JEPI. I think that's the option ETF, isn't it, around options? That surprised me. I'm not surprised by the top 5, if I'm honest. I would have expected Johnson & Johnson maybe to be ahead of Altria, I would say, from a dividend stock ownership. But yeah, the option one definitely caught my eye, and that's purely for the yield, I would imagine.
Yeah, and I don't know how long you guys have been involved in the investing industry and so forth, but there are definitely good ETFs out there, and there are definitely bad ETFs that take advantage of investors. And I'm not necessarily saying that's the case with JEPI, or JEPQ, which is another one out there. But I think most people investing in it, going for the yield, may not have the full context of how those funds work and whether they're a right fit for everyone. So essentially how they work is they're selling covered calls on securities, and they may be longer term or short term plays, but they are definitely high yield. The price has been rather consistent over time. So for people in retirement, maybe an option to consider. But you've got to look at how options are taxed versus regular dividends, because that can affect what the actual after-tax yield is for you. So with any sort of covered call strategy, when you're selling and getting the premium, that's going to be taxed as ordinary income at your tax bracket in the U.S. Is how it's treated. Whereas qualified dividend is going to receive the lower tax treatment. So not necessarily saying they're bad ETF investments, but I think people just need to get more informed about what they are, how they work, and if it fits in with their investment strategy.
They became really popular 2-3 years ago. It was like all over social media, like buy income now effectively. I don't know. I don't own any of this. We have now an European equivalent also from the JEPI that we can buy. I'm not a fan of them. I don't treat them as dividend investments. I know they pay out a yield, but for me, those are not dividend stocks, not dividend ETFs. The issue that we often see, Nathan, is that over the last 2-3 years, many dividend ETFs stayed flat in payouts. Not SCHD, it's kind of a big exception, but many of them, they stayed flat. And do you know why that typically is? Has it to do with the sudden growth and popularity of something like that they all the time need to front load? And here, for instance, they then need to pay out more dividend at the end of the quarter, or maybe after the half year. It's European ETFs, the same dividend, but to more investors because there was so much inflow.
Yeah, a lot of it has to come down with the covered call strategies that they're using. So I won't get into the detailed insights of what the covered call strategies are. There's plenty of information online about it. But in bull markets, you're not going to get the full return of the markets when writing covered calls, as you would be in those sort of strategies. And then when markets are down, you should see less downside risk. So typically that's going to explain why maybe they're flat or haven't seen the returns that maybe over the last 2 or 3 years somebody investing in an S&P 500 fund would see. Also conversely, they're probably, I haven't looked at the performance numbers over the past 3 months or so, but I'm guessing they're a little bit better than the market, but not entirely sure.
Yeah. So I'm not surprised by the top 5 either, Nathan. I think Apple was very popular also when Buffett was buying it, and then it had like a nearly 2 or 3% yield. So if people held on to it, then that became a large position for many people. What I'm, for instance, surprised with is that AT&T is still in the top 10. I mean, that beats the hell out of me.
Yeah, I mean, old habits die hard.
Yeah, but is this the case that people owned it already and they just don't sell after a dividend cut, or is it more like, well, this is like more recently all acquired? Yeah, that's interesting.
I mean, yeah, it's tough to tell, but I mean, if you look across various information online, you do come across a lot of information saying, hey, invest in big telecoms if you're interested in dividends. And maybe everyone doesn't do the research that they're looking for. Maybe they've held it for some time and they just rely on the income and don't want to sell. Could be a number of scenarios that necessarily don't see in our data because we don't track anything other than holdings in a portfolio.
Exactly.
And,
nice one.
There is one company that stands out to me. I mean, there's 40, maybe 44 companies here. Most of them US. There's obviously Enbridge, which is Canadian. But right down at the bottom there, you've got Legal and General on the London Stock Exchange. On its own, the only one that we can classify as Europe. That's interesting, right?
Yep.
I wonder what it's about, that company.
High yield.
Yeah, yield for sure. And I would have expected to see some more kind of LSE-based securities, since we do have like I said before, our second most popular geographic location is people investing in London securities. So it's interesting in there, but I think a lot of that goes to, and I don't necessarily know the situation in Europe, but I think a lot of people look to the US for kind of the safety in various dividend stocks, and it's one of the biggest markets out there for that. So naturally, you're going to have ownership. It's going to reflect that in the ownership data.
Of course.
Yeah, but legal and general is still very specific because it's a British insurer. It has 8 or 9% yield, but if you look at what people are buying a lot in Europe as well, is LVMH, ASML, L'Oreal, Novo Nordisk, Unilever. Yeah. So I would have, indeed, to Derek's point, I wouldn't have expected, if you would have asked me 10 times the same question, choosing another answer, I think legal in general would still not float up.
Probably not.
Yeah, very interesting.
Yeah, interesting. And what about you, Nathan? What kind of companies are you interested? I mean, is there any in the top 5, or what type of companies do you typically own? I know you mentioned tech and restaurant companies.
Yeah, I mean, I'm definitely on some in the list that we've got there. But I'd say my focus now, where I am in kind of my investing journey, is I'm still in the dividend growth phase because I can take the risk at this point. Retirement for me is 10 to 20 years away. Mm-hmm. So I'm sure you guys have heard before, but if it's money you need in the next 5 years, you shouldn't be invested in the market. And luckily, my time horizon is a lot longer than that. So I do look for some of those higher growth dividend options out there because, they're double compounders. If you can get the price to compound and the dividend to compound over a long time frame, there's not many opportunities like that out there. So yeah, I own Apple. Yeah, I own SEHD, the high dividend ETF. I also own the Vanguard equivalent VYM to get exposure, and then some of the other dividend stocks. But I know you guys mentioned, we'll chat about maybe some dividend stock picks. But one of them out there, and this is definitely on the riskier side, and it's making a bet on the long-term future of it being a dividend aristocrat, but it's not there today. But Broadcom, AVGO. I don't know if you guys come across that too much when talking dividend stocks, but it's in the 1 trillion market cap club.
Yeah. One of our first guests on this show, maybe five and a bit years ago, he was from South Africa, and he pleaded with us for months, and I say months, before he came on the show and after he came on the show, to look at Broadcom. We ignored him, and I think it's my biggest regret since. It's been an incredible story. I mean, what's the share price trading at now? It was phenomenal.
I have no clue, but he's probably somewhere in the ocean on his yacht.
I mean, I haven't heard from him in about 3 years, so I'm assuming...
No, he's retired probably and flew off.
Yeah,
here we are making podcasts.
I mean, if you look at it kind of from the fundamental side of it and so forth, it's got a 1 to 2% dividend yield. It's in the 1 trillion market cap club. So you kind of question like how much further can it grow? But that's been the question for everybody over time investing in stocks. Is like, I think we underestimate how big these companies can get over time. And it is, from what I've seen and researched, the only current somewhat stable dividend stock that has exposure to AI over the next decades. NVIDIA pays a dividend, but I don't think what their yield can qualify as a dividend. But there's also less risky dividend growth options out there. And one that I'm doing more research on, I use this with my screen to come up with, but is ADP, automatic data processing. Okay. It's been a tremendous growth story over time. And most people probably know about the company because they get paid through ADP, through their payroll services. 1 in 6 Americans gets their check through ADP. But it's been a fantastic growth story over time. It's got all the things you look for in a dividend stock. It's below 60% payout ratio, near 10% dividend CAGR and EPS growth, big market cap. It's not over levered with debt, 42 years of increases. Like, these are perfect metrics for a long-term buy.
How do you compare ADP to a company like Paychex?
I mean, you just have to look at whoever started in the market first has that first mover advantage.
Yeah.
Whether they have the better product or not, they have advantages over time.
It's a bit like SAP then.
Yeah. Yeah.
see what you
I
mean.
mean, you can't underestimate those first mover advantages.
Yeah,
People just become accustomed to them. So.
Yeah, and then you have like a lock-in as a company because moving away from it is very, very high switching costs.
Yeah, and two, considering ADP, no company is 100% immune to cyclicality, but it's a rather defensive stock. If the markets go down and the economies go down over multi-year timeframes, people still need to have their paychecks issued. HR is still important for a company, and then you add in the switching costs of needing to move to another company. It's pretty defensive when you consider it. So add that into all the other metrics. It's a pretty interesting investment. So I don't currently own it, but I'm looking at it.
Yeah.
Do you have a minimum yield that you start with? I know you mentioned Broadcom, you now mentioned ADP that have maybe 1-2% yields. Is there a minimum that you start with?
So I'd say break it down by the type of company I'm looking for. So if it's a dividend growth company, 1-2% is probably going to be, if I'm making a long-term bet on it becoming a really sustainable player over decades, it's going to be really low percentage yield currently. But if there's something that I'm just looking for more of a current reliable dividend payer, it's going to be 3 to 4, 5% is typically what I look at.
Oh, okay, nice.
Yep. And I know there are options out there, BDCs, REITs, like I've mentioned before, but it's just not an industry that I've followed too much over time and really feel comfortable investing in. But naturally, they're going to have higher payout ratios higher dividend yields that in many cases are sustainable and high.
Yeah. Nice. We have a couple of listeners' questions. I think we've got 3 or 4. We might ask some of those, and then we might get on to, as you mentioned, asking you for your stock picks. I know you mentioned ADP, but we might get a little bit more into that. Tim has asked us, in the spirit of Easter, what's the golden eggs in your own portfolio, and which ones are the crappy chocolate eggs you want to get rid of? So either one.
So, Viatris, I will get rid of. Just simply because the business is not anymore the same as when I bought it, and I've been holding on that one for too long. But like I mentioned earlier, it's nice for tax harvesting because I sold some Apple in the beginning of the year at a very large profit. So that's definitely one first on the list. And I just need to push the sell button there.
Yeah. What about you, Nathan?
So I'm just reallocating essentially at this point. So I was heavily invested in some ETFs, just broad market index ETFs, and I'm moving more toward lower cost options from some of the large providers out there that just have higher yields. So traditionally I was invested in SPY, which is a SPDR S&P 500 fund. But now reallocating that mostly to SCHD and VYM, the Schwab and Vanguard high dividend funds. So not so much stock specific, but the bad eggs in my basket, not so much bad eggs, but just looking to get out of certain positions and allocate elsewhere.
Yeah. I think I got rid of most of my bad eggs over the last couple of years. I got rid of Viatris recently as well, but the only one left is Enagas, who cut their dividend. I haven't yet sold them. They're on the list to sell because they're a Spanish utility, Nathan. I don't know if you've heard of them, but the management lied to us. They told us there was a dividend floor for at least 3 or 4 years, and then they cut it because they're making huge investments in their infrastructure, which I get and I understand, but don't tell me that you have a plan to keep the dividend flat. So that's probably one I will be definitely selling soon. And then what about the golden eggs? What's the top ones in your portfolio?
Current portfolio or what I'm looking at?
Either, whichever suits.
Yeah, I would say the one I'm most interested in is ADP.
Yeah,
it's got really good financials and performance over time. It's just been a fantastic return over decades. So that's the one that I'm most interested in. That's the one I'm listening to earnings calls on currently and doing all the analysis. So I'm excited about it. We'll see if I end up getting into a position there, but it's interesting.
How about you, European DJ?
Well, I use this opportunity of the market coming down to pick up some companies that I always wanted but never could buy. Novo Nordisk, LVMH, these kinds of stocks. the yields are starting to become attractive. I know that many people feel like, this their earnings, they're not what they are anymore. I mentioned before that they're more cyclical. So, but I would not bet against Bernard Arnault as an example.
Yeah.
So for me, they are now really coming into that zone because the multiples become more reasonable, that I start to look at them. It doesn't mean that I'm like full on a buying spree there, but it's more like, when you see those movies, there's an airplane starting to enter the radar. They are not yet in the bullseye area yet, but they're starting to entering there. So I'm observing those now.
Yeah, nice. El Cuba has asked, what companies do you think should do split-offs? And he gave like Siemens as an example. So is there any US companies, Nathan, that you can think of that should do split-off or spin-off?
I think the government's going to force a bunch of spin-offs. Whether or not I think they're a good idea is a different story. To be honest, I don't know if I have anything immediately on the top of my head, but I read some headlines recently. Both Meta and Google are going through government inquiries and trials, and they may be broken up over time. But you have to question, maybe kind of more on the dividend front. Microsoft has been through this in the early 2000s. They were broken up and essentially had 14 years of flat performance and have been on a wild trajectory since that point. But I honestly, maybe we could look at it this way. Any company that is 2-3 trillion market cap, it might need to be broken up and spun off. That's a lot of pricing power. That's a lot of market power. There was an interesting stat recently. I'm going to fumble it here and don't take it as the exact number, but some of these mega cap companies are, 4, 5, 6% of US GDP. Mm-hmm. And they haven't been at that point in many decades. It's a rare outcome. So, that's massive market power.
Think about Novo Nordisk. Isn't Novo Nordisk larger than the Danish economy?
Yeah,
something like that, right?
Yeah.
It's also crazy.
Or ASML, talk
yeah.
about like the most competitive market position of any company in the world. Maybe the Dutch East India Company historically over the past centuries, but nobody else creates the lithography products that they do.
But you can't break them up, ASML, right? You can't, because it's either you have a EUV machine or not.
And similarly, Taiwan Semiconductor. And I know the U.S. strategically views national security as an important thing in bringing some of that manufacturing onshore. But if you look at, if Taiwan was invaded and Chinese cut us off supply, that is unheard of massive market disruption for everyone globally.
Exactly. I think we have a total different podcast episode in that case. Talking about a black swan event, that will be it. It's for me with this question, I start naturally thinking more about those holding companies. And then those holding companies that are ineffectively managed. And General Electric, we see now, is more worth the parts alone than the sum of the parts, right? We can see that, and the current CEO there, he deserves a statue, I think, for what he has done. But it's hard to think of anything. I was thinking a bit about pharma, but nothing comes to mind either.
Yeah, you mentioned holding companies, and Fresenius came to mind for me. They've got many different parts and quite complex in structure.
I do think that Unilever can spin off some things, but it's doing that already. So there's also nothing new there. It's more like Nestle, maybe. I think Nestle needs to find back growth. So Nestle could, for instance, spin off the water business or something like that.
Yeah. Or IBM spin off Red Hat.
Is IBM spinning off Red Hat?
No, it's not, but I'm saying
Well, they should do, and then declare the rest of IBM bankrupt.
And the last question comes in from Carlos, and he's asking, have you ever convinced someone to start investing, and how did you do it?
I convinced my 7-year-old son. I mean, to my history has mostly been in the online space, so you necessarily don't see how your feedback and opinions reaches the end user. So I'm sure in some form or manner,
Yeah.
I've gotten people to invest, but close family, just being invested in the investing industry and family, they're naturally going to ask over time, hey, what are you keeping your eye on? I'm interested in getting started. Like, how do I actually do that? So yeah, I have, and really just the thing I always focus on, and you learn this with the experience over time, is just ignore all the noise. Like, investing can be incredibly simple. And for 99% of the people out there, they should probably just have a diversified ETF strategy.
Yeah.
3 to 5 ETFs, dollar cost average into a monthly or quarterly or whatever cadence you feel is right, and just put it on cruise control and ignore your portfolio, which is like an odd perspective from, our company, where we create a portfolio tracking product.
Yeah.
We want you to check it, but also at the same time, I don't want all of our users to go in there daily and check their portfolio. It's like kind of how we build things too. Like, we strategically don't put certain things front and center that we don't think are important.
Yeah.
So sure, we'll cover your daily gains.
Have you considered removing the login button on certain days? For instance, when the stock market is up more than 2%, you just remove the login button and you say like, please don't, for the sake of yourself. Thank me later. Your subscription, your membership paid already back for this today to not log in.
Yeah, but I mean, like, sure, yes, have helped people get invested, but it's a question I ask as kind of the product owner over time, is like, how do we actually build this in a way that matters for people and conveys long-term investing and doesn't get them into the traps that they're likely to succumb to?
Yeah, exactly.
So it's really a challenge.
Yeah.
How about you guys?
Yeah, I'd say it's quite a similar story. You do have family that would always ask, family and friends, and what I find is they will ask and want you to tell them what to invest in, and I'd never do that.
Yeah,
because if it goes wrong, they'll come knocking on my door saying, "Hey, I lost 10,000 euro because you gave this." So I'm with you. I always tell close family and friends that are not passionate about investing, stick to ETFs. There's a book I have here, and I give to them. It's The Simple Path to Wealth. I don't know if you read it, but it's basically what you said: buy an ETF, forget about it, automate your savings going into it, and just forget about it. But we do get lots of feedback from the podcast of people who are just starting and getting inspired, and it's actually quite inspiring for us to listen to, especially when they reach out to us at the beginning and then they reach out to us maybe 4 or 5 years later, and you can see how far they've come. That's always, actually, we love hearing those stories. We hear them quite a bit, but I don't know if I've directly convinced someone to start investing. It's quite difficult.
Those are the stories that need to be told, because if you look at the financial markets and companies as a whole, I don't think they're overwhelmingly set up to get DIY investors set up for success. So, if you look at it, most of the investment banks out there, their incentive is to get people to trade in the securities. That's why there are consensus buy and sell estimates from analysts covering targets. Is they're trying to drive trade volume to their firm. That is all it is. When they're adjusting their price targets and management calls. And then you look at wealth advisor space and so forth. They earn from fees, and it's a challenging industry for new people to navigate. So if you can convey the message of simplicity, it really is critical, and more people need to hear it nonstop.
Yeah, nice. We've actually got a couple of retired investors in our Facebook group, retired from investing, and we've had one person from Canada on the show. We're trying to get a couple of others who don't want to come on. I'm not going to name them. We email them quite a bit, but it's actually quite inspiring to see people going through the process, how they've done it, and how they're living their life after they've reached financial independence. Because that's something that you think, okay, I'm going to be financially free from doing this. But what does that look like when you get there? It's a whole different story, but quite interesting. But the last piece then is around our community dividend growth investing portfolio. And just a bit of background story to this. What we did is we reached out on all our social media platforms, and we asked our community members to pick their top 10 dividend growth holdings, right? And we compiled all the answers. There was a couple of thousand answers, and we picked out the top 10, and we put them into a portfolio. I have an ETF on Trading 212 with this portfolio. And anytime we get a guest on the show, what we do is we ask them to remove one from the list and include one in, right? And I've shared the list with you. So far, we have Visa, Microsoft, Johnson & Johnson, Realty Income, ASML, L'Oreal, Shell, Agree Realty, LVMH, and British American Tobacco. Now, your job is to kick one of these lovely companies off our list and replace it with a company that you think is worthy of being in this portfolio.
Yeah, I'll happily kick one off, and I hope it doesn't offend some investors out there, because it is a favorite holding that you always see dividend investors focus on. It's British American Tobacco, and there are a few reasons. So first, just kind of looking at the fundamental factors, the growth story over time. It's just not a sector industry that I believe has long-term growth potential. And then kind of the broader factor that I look at that is really important is I had a mentor, many mentors in investing, but one from a mentor that really stood out is invest in your vision of the future. And my vision of the future is not everybody on earth vaping and smoking cigarettes. So I just don't think it aligns with that perspective. And you naturally see how, Philip Morris, Altria, British American Tobacco, how they've grown over time. They've been good performers, but they are essentially shut out of large markets by regulations and education, and people learn the health effects. And then they went to different Asian markets where they're less regulated, or different African and European markets across the globe, to continue growth from there. So I think over time, we're talking 30, 40, 50 years, I think those geographies are going to become more educated, and essentially usage rates, adoption rates over time, it's not a favorable outlook. It's a great yield. It's got some factors that are really enticing.
But Nathan, to defend management, they have a strategy to build a better tomorrow. And
well, let's hope they do.
And are they a tobacco company? Because you mentioned you like technology stocks, and aren't they a technology inhalation stock?
I mean, yeah, true. Their biggest products now you look at are kind of their non-smoking nicotine-based products. But it's just kind of looking at it, my vision for the future. I think there are better opportunities out there that I really like, that align with.
We're fooling you, teasing you, Nathan.
Yep.
Because that's the funny thing. That's how employees in this company sell themselves. No, I don't work for a tobacco company. I work for a technology inhalation company.
Yeah, okay.
We can solve bronchitis or something like that, and breathing problems. Yeah, so where are they, those products? Well, yeah, no. Yeah.
Yep.
Yeah,
well,
but
I mean, part of management's responsibility is to market their company in whatever manner possible and to define the narrative.
Yes, making it better tomorrow. But I like your mantra, invest in how you want to see the future, which is quite a nice mantra to invest in. So we will remove British American Tobacco from our list. We will replace it with ABP, which will bring down our yield significantly, I would say. We're replacing a 7% over the 2%, but we're not here for dividend yield. We're here for income. So good choice. Nice choice.
Thank you.
And that's it. Nathan, I want to say thanks so much for joining us today. It's been a pleasure talking to you. I actually really enjoyed this chat, and I hope you did too. So thank you for joining us today.
Yeah, it's great. Glad I could jump on. Really had fun.
And Nathan, where can people find you if they want to reach out to you?
So our website is dividend.watch. That's the easiest way just to kind of get in touch with our product. But if you have any questions as well, I'll provide my email. Happy to do so if you feel that would be worthwhile.
Okay, so what we will do, we'll put the links. If you provide us the links, we'll put them in the show notes of the podcast so people can easily reach out to you. Are you also somewhere on social media around with an account?
I don't have a ton of social media presence. Mostly LinkedIn is where I focus on things now, but not a ton of social media presence currently.
Okay, so we can add your LinkedIn profile.
I'll provide that to you guys.
Yeah.
Yep.
Awesome.
Perfect. Okay, listen, again, thanks so much to our listeners. As always, thank you for tuning in this long. Thank you for all your questions. And we will see you all next week.
Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.